Now let's talk about macros. The probability of an April rate hike by major global central banks looks unlikely as of now. But for the European Central Bank, markets price in a 0.25% hike by June and at least one more later in 2026. While rate hike bets are largely driven by oil prices, its extremely volatility has also distorted rate pricing and liquidity. Still, positive geopolitical headlines and the latest dovish growth signals have lowered the April odds of an ECB rate hike to a 25% chance from above 50% last month. Much will depend on the oil price, because for every $10 increase in the oil price, the market's hiking expectations increase by roughly about 0.25%. Similarly, for the Fed and the Bank of England, the correlation between policy and expectations in oil prices remains very tight. With current volatility in oil markets, a $10 move can materialize in just one day. The wild swings in global financial moves make it difficult for market players to take positions. That is potentially distorting the relationship between actual expectations and market pricing. Even if an investor has a high conviction view of a central bank's reaction, taking a position is risky. The reason? A single geopolitical headline can trigger a sharp jump in the wrong direction. The relatively hawkish pricing of central bank reaction just last month may not fully reflect market expectations. Nevertheless, markets continue to guess the direction of policy rates, and the many central speakers slated for the week this week can help. On Tuesday, the IMF emphasized the risks to growth dynamics in the current environment, which should temper rate hike expectations. The focus from ECB's president on data dependency also suggests April might be too early for a change in policy.